Okay, so today I'm speaking with Tim Hill from Dominion Lending Centers, and Tim's going to give us some clarity regarding the new mortgage rules. So recently, the mortgage regulator, which is the Office of Superintendents of Financial Institutions, has come up with these new rules, and they're going to be very far-reaching, and there's a lot of confusion going on right now, Tim, about it. So we'd like to get some clarification. We understand that they're talking about stress tests and how that's going to affect lenders. So could you help us out with that?
Sure, Gary. Well, the stress test is basically to make borrowers qualify as if their mortgage is at a higher rate than it actually is. And the reason for that is that they want to make sure that if rates do go up in the future, that people are still going to be able to afford their mortgage payments.
Okay. And so could you be more specific? Like exactly what I understand was initially they had these stress tests for insured mortgages, so that would be mortgages where they would be less than 20% down. They now added to the uninsured mortgages. So how exactly, specifically, would it affect them in terms of that stress test?
Sure. Well, OSFI is continually revising their guidelines, so the federal government regulator of banking in Canada. And the last few years they've gotten considerably more restrictive in the lending criteria that lenders are allowed to use. Specifically what's happened this time is that conventional borrowers, that is people with more than 20% down payment, will be required to qualify as if their mortgage is 2% higher than the actual rate on their contract. So if you have a mortgage at 3.19, you'll have to qualify as if it was 5.19. The actual wording of it is that it's the greater of the Bank of Canada benchmark rate or 2% above the contract rate. And the Bank of Canada rate is currently 4.99. That would come into play for lower rate mortgages, such as on a variable. You might have a variable at 2.8%. Well, if you add the 2% to that only gets you to 4.8. So they would push you up to the 4.99 as your qualifying standard.
Right. So Tim, could you give me an example, say, of a regular mortgage? Like, how far-reaching would it be?
It's actually a very big change. I mean, most of us just sort of look at them and they're kind of numbers on paper, but to give you a real example, Gary, if someone had currently qualified for a $400,000 mortgage, if they were at their limit, under the new guidelines, they may only qualify for something like $290,000. That's over $100,000 drop in their buying power.
That's a big difference.
It is a big difference.
Yeah. Now, could they do something in terms of maybe having a longer amortization period to help out?
Well, traditionally, that's what we've done. Mortgages are traditionally done on 25-year amortization, with 30 and in some cases even 35 years being the exception. However, what they're telling us now is that for these conventional mortgages, as they changed with the high ratio mortgages last year, are limited to 25-year amortization.
Okay. Now I'm just thinking, now the rules come into effect on January the 1st, correct?
Correct.
Yeah. So what about a buyer that's already got a contract in place? Are they going to be able to go with the old rules, or do they have to go with the new rules, say, if it completes at the end of January?
Sorry. Yes, Gary, that's a clarification that we just got. If you have a contract in place, what matters is the date on your contract. So if you sign to buy a home on December 31st, you'll be grandfathered under the old rules, regardless of when the property actually closes. Similarly with the refinance, if you have your refinance in place before December 31st, you have up to 120 days to do that transaction. The exception is with pre-approvals. If you've been pre-approved for a mortgage at this time, after December 31st, it's no longer valid.
Okay. Now, what about buyers that are pre-buying, say, on brand new condos where it might not be ready for 2 or 3 years?
Again, according to the clarification we got today, they will be grandfathered under the old rules as long as the date on the contract is prior to January 1st, 2018.
Okay, well that's good. Now I'm just thinking, what can borrowers do obviously these rules affect the big banks. What about, are there any other sources that they can go to get their mortgages?
Absolutely. There's always credit unions and trust companies and mortgage finance companies. And just looking between them, the rates can be considerably different. So, where you might be looking at 349 for a bank, which would have you qualify at 549 under the new guidelines.
Mm-hmm.
You may be getting 319 from a mortgage finance company, which would put you at 5.19. The other big exception to it is with credit unions. Now, credit unions, as I'm sure you know, Gary, are actually regulated provincially, so they don't fall under these new guidelines. However, FICOM, which is the body that regulates credit unions, has said they're following the changes very closely, but have not announced any changes yet. So, credit unions appear to still be under the old rules.
Okay, so we still need clarification on that to know for sure.
So far, yes. So far, the working assumption is that until they announce a change, they're still going to be under the old rules.
Okay, great. All right, well, thanks so much for that, Tim. I think that helps out a lot in terms of clarification. We've got a lot of answers that are just coming in very recently, I guess as recent as today.
That's right.
So we're getting more clarification, and thanks for your time today.
Thanks, Gary. Thanks.